Good afternoon. Welcome to the i3 webinar co-hosted with 24 Asset Management on the subject of ESG in fixed income, or if I could even rephrase it, can bond managers invest responsibly? I'm Tech 10 with i3, and joining me are two senior executives from 24 Asset Management's London office. Chris Bowie, a partner who manages the outcome-driven business, and that sits between asset-backed and multi-sector bond. And Charlene Malik, who is part of the multi-sector bond portfolio management team. Chris also sits on the firm's ESG steering committee. So welcome to both Chris and Charlene. For those of you who may not be aware, 24 Asset Management is a fully owned boutique of the Vontobel group, specializing only in fixed income. Now, most of us will be familiar with the integration and implementation of ESG practices in equities. Fixed income and bonds, as well as credit, is somewhat less clear. So hopefully we can try to uncover and unpack some of the issues here today. Now, instead of the usual presentation describing, or rather prescribing, what investors should do, I thought we might try something different today. So let's talk about the hard stuff, the stumbling blocks, the trade-offs, the decision dilemmas. So I'm going to put our speakers on the firing line, right? I'm just kidding. But to address that, look, in a synopsis, I think the audience, you would have seen, we've highlighted a number of issues, and these include, incomplete data, and this is probably the serious pain point, ratings, discrepancy between credit and ESG, engagement, does it really work in the fixed income world? The confusion between ESG integration and sustainability bonds, and the plethora of labels in between. Obviously, you have to cover green bonds, as well as greenwashing, which is holding the headlines quite a bit, and we'll cover that. And last but not least, government bonds. Are they deemed sustainable, or is there a place for them in a sustainable portfolio? Now there could be more, and I really encourage you, the audience, to tell us your problems. If you could add those to the question box on this platform, we'll attempt to address them in the course of the conversation. So before we get started, a disclaimer. So this webinar is for educational purposes only. It does not constitute financial advice. It is intended for wholesale and institutional investors only. So we've got about 40 minutes. Let's get cracking. Welcome again, Chris and Charlene. I'd like to start with, let's cover probably the most painful bit, and that's data or data, or the incompleteness, the lack of transparency. I think we all know that, look, with most data, it is equity-centric, or rather, that's the starting point in most cases. There's a lack of data, incompleteness. Maybe, Chris, I could come to you first. Can you describe that problem for us and the gaps, and again, how do we then, or as fixed income portfolio managers, sort of overcome that gap? Chris?
Of course, yes. So we look at global credit. There are tens of thousands of companies that we could invest in. The problem that we quickly identified was, if you look at third-party ESG databases, and I'm talking here about MSCI, Sustainalytics, or Asset 4, which is from Refinitiv, they generally are all based on the published accounts of listed equity. And that only takes you so far in the credit world, because we have many private companies, we have mutual not-for-profit companies, we have special purpose vehicles, and especially on the asset-backed side, you have issuance that doesn't come really from a corporate entity in many cases. So the problem we have is we quickly identified that if we look across investment grade and high yield, approximately half of our world is in companies where you just simply cannot buy a third-party ESG score. You're going to have to do the work yourself. You're going to have to score these companies from scratch. And what we generally found was, the further you go into high yield, and even geographically, perhaps the more you went into the US, the harder it is to acquire this data. The mindset of many companies is often quite resistant to being asked these questions if they haven't been asked them before. So actually, Tech, if I could ask you to bring up slide 1, please. What we have here is a distribution of the scores in fixed income. On the left-hand side, the bluish shaded area is really the companies that we have scores for, split between investment grade and credit. And you can see investment grade and high yield, I should say. So investment grade is the darker section, high yield the lighter. And what you should start by doing is, if you look at the 50th percentile on the left-hand side and read across and then down, what you can see is on average, the high yield score tends to be lower than investment grade. And this makes intuitive sense. Perhaps it's the business profile of the company, or perhaps they don't have the same investor relations team and therefore cannot profile their responses as efficiently. What we've seen over the last few years is that the average score is moving rightwards in both cases, that companies across the world are scoring better, they're taking this more seriously. The problem is, if you look at the green version of the distribution, this includes the portion of our high yield and investment grade indices that are private companies or mutuals or SPVs, where you simply can't buy a score. And it's about half of my world in investment grade. Charlene is more on the high yield side. So you can see we start from a position of trouble, let's say, where if we want to invest in that half of the world that you can't buy a score for, you have to do the detailed work first. So Charlene, I'm sure you have some experiences of gathering the high yield data, perhaps, that could be useful.
Yeah, so we've definitely found that there's quite a big difference at the moment between trying to gather some of this data for European companies and for US companies. I would say perhaps the US is a little bit further behind in Europe in terms of ESG, but it is catching up fast. So obviously for us, when there isn't a score in the system, as Chris said, we have to go and do that work ourselves, and that means kind of arranging a call with management to kind of get down into the details and really kind of hammer into what they're doing. And often we find that they are doing a lot, but as Chris said, they don't necessarily have those resources to be able to kind of respond to the questionnaires and put together nice CSR reports to kind of sell themselves the best light possible, but they are doing a lot. In the US, we are finding that increasingly so, but it is a challenge to get that information. I don't think they're used to being asked those questions yet, in terms of what their carbon intensity is, what their split of their workforce is, what the diversity is. We expect that to change very quickly going forward, but it has been a challenge to date, yeah.
Chris and Charlene, if I could stay on this particular slide where, again, the left-hand side, the bluish graph, I guess it talks to the current provider where you source information, whereas on the right side, green is where your team has done the extra legwork to try to get that data. I get the impression that, when looking on the left-hand side of especially the blue graph, where less or rather poorer performing companies from an ESG score standpoint tend not to disclose. So am I right to say as you do more homework and as you uncover, those who tend not to disclose too much or if any at all, tend to be poorer performing. Is that a right assumption?
Absolutely, yes. So if you look at the left-hand distribution, this is the universe of companies that we've either got third-party scores for or have scored ourselves. The right-hand side includes those companies that we don't yet have a score for. However, when we've been going through that 55% of investment grade, we've tended to find when we do score them, they tend to score on average worse than the existing cohort. And we find out also with CO2 data, which is, I'm sure that's a topic will come up later, that generally companies where you have to work harder to get the CO2 data, the average CO2 data is then worse. And it's the same with the average ESG score. Many companies have taken the view, look, I probably am going to profile not so well, so I'm not going to push that information out easily for you.
Sure. And Charlene, I'm wondering, on the flip side, are there examples of, say, high yield companies that may not have as great an ESG disclosure, whether it's for lack of resources or other reasons, but still rate well?
Yeah, definitely. There are still some that surprise you when you kind of have that call with investor relations or the management team. And in some cases, they're already 100% renewable energy in all of their offices and branches. In other cases, they have really strong programs in place to increase diversity. So you often find companies that don't sell themselves in the best light possible, but when you dig into it, they are doing all the right things. However, on the same side of that coin, there are companies, when you dig into it, they aren't doing enough, and those are the ones that you either really need to engage on or kind of maybe need to stay clear until they're doing better.
And again, between the difference between investment grade and high yield, do you observe the differences where investment grade companies tend to disclose more or are better at disclosure? versus high yield companies?
In fact, actually, if we could jump please to slide 3, I think for us this was a real eye opener when we started doing this work a few years ago. The left hand side here shows the distribution of scores from one of the third-party databases that we have access to, and under their model, 0 would be the worst score possible, 100 would be a perfect score. And you can see most scores are clustered in that 30 to 40 range. In fact, the median score is 36. However, what surprised us was on the right-hand side, we found companies that tended to often look good on these metrics were companies that we kind of scratched our head and thought, that doesn't feel right. It doesn't feel like they're a good ESG company. So an example would be, for example, Coca-Cola, a big user of plastic, clearly. Royal Caribbean, a big emitting company, as is Union Pacific. And when we looked into the weeds, we found that these companies have huge investor relations teams. They're very good at profiling their responses. They can appear best in class, but end fund ESG buyers might not think of these companies as ultimately being good or a force for good or moving the right way even. So, you know, the distribution of the outcomes is very important here. And also the companies that scored badly really surprised us. There were some examples here, you know, Alibaba, yes, Netflix, Ryanair, even Tesla. We thought that makes intuitive sense. What we couldn't understand was Willis Towers Watson. And when we looked into the data, their raw score, which is essentially the inputs of the ES and G, was very good. They had been marked down simply because over the last few years they had made some bolt-on acquisitions, and that had been price sensitive for the equity. So the key point we make with this slide is anybody who's using scores like these needs to be aware of the methodology. They need to understand the value judgments, because quite often they are going to disagree with how these numbers are arrived at. And you know, this is an investment grade universe, but I'm sure there's even wider dispersion within the high yield space.
Yeah, I think Chris reminds me of, you know, often there's talk, and I think if you like, Tesla is often the poster child for some call it the controversy, where you're good on certain scores, like Tesla is good on the E part and not so good on the G part. And how do you then score? And the commentary I hear is sometimes it really depends on the provider that you speak to or that you get the information from. Chris, you had talked about, you know, rating ESG controversies.
Yes.
What does that mean?
Yes, if you could page back, please, one to, you can see our data model. And essentially, we have two ways of looking at a company. The top row here is essentially how they are today. And the bottom row is essentially where are they headed? What does the future look like? Now, under the top score, you can see that we have two numeric inputs. We have a raw score, which is essentially the weighted average of the E, the S, and the G put together. And the weightings do differ by sector. So, for example, if we were looking at a coal investment, the environment score would really drive that total score. Whereas when you're looking at a bank, actually, the social category tends to be the most important. But you can also see there's something there called controversies. Now, when the third-party data provider that we use, which happens to be Asset 4, talks about controversies, they usually mean things like scandals. And that's very useful to get that data because it can really alert you to some problems with management or the culture with a company. But we also find that controversies can be behavior that is price sensitive for equity, but is not necessarily evidence of bad ESG behavior. And Willis Towers Watson was the good example there, where acquisitions or mergers, yes, it's price sensitive, but it is not ESG bad behavior. So, you know, Tesla's a great example. We've seen many controversies from Elon Musk. Many times controversies really help alert you to problems, but sometimes you have to override them because you say, well, this really isn't a controversy, at least not from an ESG perspective. Therefore, I'm going to override it. I'm going to change the score here. At the bottom, I'll just mention the additional things we do, which is really momentum. Momentum for us, we think, is one of the big wins in fixed income. It's essentially identifying companies that perhaps today don't have the best ESG score, but they are committed to change, and we want to be along for the ride because we feel that journey that they're on will benefit everyone. Society will benefit from decarbonisation or for an improvement in their social policies. The bondholders will benefit from a fall in the cost of capital. And in many ways, we see this as the flip side of green bonds. You mentioned green bonds in your introduction. Funnily enough, that's a sector of the fixed income market we don't like for reasons I'll come on to, I'm sure. Instead, we prefer companies that have still got some work to do where everyone can benefit. And lastly, engagement. You know, we're a credit shop. We don't have an equity team. We don't get to vote on anything. But engagement is where we have power to influence change. And we actually record all of our engagements and report on them monthly to our clients because we know this is such an important topic for them.
Mm-hmm. Charlene, any examples from you in terms of the controversies? It's often, value judgment versus objective data, and whether you could bring it all together.
Yeah, definitely. As you say, it's something that we always discuss as a team, because what one person considers to be a scandal, someone else might not consider it to be such a big deal. So we always have a team review of it. I guess I'm trying to think of any real examples I've had recently. For instance, there was a company that we were looking at, and it was a dairy producer. And there was a recent scandal in the press that they had child labour in some of their, not in their company directly, but in the supply chains that they operated in. So for us, that sent alarm bells ringing, and they were doing a new issue at the time. So we decided to reach out to the company to basically see what was going on, if this was true, if it was true, what steps they had taken, and what they had put in place to make sure that this wouldn't happen again. And to be honest, this also ties in with engagement, as Chris was saying, is we found that they responded straight away, and they gave a quite thorough, quite a detailed response, and they'd hired an NGO to look into it for them. And they found that the claims were false, but at the same time, they still had adopted, they had advised on new protocols that the company could take, excuse me, to make sure that this wouldn't happen at any point in their supply chain, and the company was in they were in the process of adopting those suggestions. So that's the time when you've seen a controversy, you've engaged with a company to see what's going on, whether it's true. And at the end, we were happy with what we got back from the company, but at the same time, sometimes we do this and we're not happy with what we hear back. And at that point, we can decide not to invest.
Yeah, I'd like to get into engagement in a moment, but if I could just finish up the issue around data or the inconsistencies. And one of the topics around, I guess, the discrepancy between credit rating agencies, and I think most of us are familiar with the S&Ps and Moody's and the Fitches of the world, versus ESG ratings. And in fact, recently I came across a work of one of your colleagues, Lara Kesterton, and what caught my attention was I think she mentioned that there was that if you look at she looked at the correlation coefficient between the credit rating agencies. And that was like 0.964, which is really as close to 1 as you can get. But when you look at the correlation for the ESG rating agencies, the correlation was like 0.493. There's like in between, really right smack in the middle, halfway between perfect agreement and complete randomness. So we know that there's this discrepancy. How do you reconcile that? How do you treat them separately? I guess it comes down to coverage, and obviously there's a whole value judgment. Comments from
exactly. It all comes down to value judgments, the questions they're asking, the weightings they're placing on those questions, and then ultimately how they're interpreting the data. So the phrase we would use is you can essentially buy any score you want. And Tesla's a great test case, because some databases say, my goodness, this is the best thing in the world, they're making electric vehicles. Other databases say, well, hold on a minute, they're using a lot of energy, they're using a lot of resources that are quite difficult to extract, and the governance is frankly shocking in many ways. So the point we make to investors is, whoever's model you pick, and this works for fund ratings as well as individual investments, you have to understand the methodology, and you have to be aligned with those value judgments, because they are very different between providers.
And Charlene, any comments from you?
Yeah, I agree with Chris. I think it really comes down into, and it works with us as well when we're having to score companies ourselves, whilst the PM looking at that name, that company will do the initial ESG work to kind of do the score. We always discuss it as a team, and that's, I guess, the same way that there's a little correlation between rating agencies. We always discuss it as a team to make sure that we kind of get everyone's views, and it's not kind of one value judgment. It's 14, 15 people discussing it and coming up with an end score there.
And do you look for consensus? It's about value judgment.
Yeah, we try to find the right middle ground between everybody's views, and often, to be honest, we're normally on the same page. It's the odd case where someone might think slightly differently, but for the most part, we tend to be the same wavelength. But when there are kind of differing opinions, we kind of tend to find the good middle ground.
Let me finish up the last question around data. And Chris, you mentioned earlier momentum. And I think in an earlier note, you had made a remark that you said, look, the best performing companies, both in terms of alpha and ESG, are those that are likely to score relatively poor on ESG metrics today, but are committed to positive change. Now, we get that in theory. How do you capture that?
Yeah, so we have essentially divided the world into how they look today and where they are headed. And I wouldn't necessarily say we're looking for companies that score poorly, but certainly companies that score around the median is a good starting point. And then if they are committed to change and the board are committed to change, then we can give them a high momentum score. And my favorite example is a UK energy company that 5 years ago, the bulk of their electricity came from coal, but they decided they wanted to exit coal by 2021. And we firmly believed in that. We gave them a high momentum score. This company is called Scottish and Southern Energy. And they managed to exit coal a year earlier than their original plan. So we've given them a high momentum score. They're now continuing the push into clean power, wind power specifically. So it's a company that, having made a very useful journey, have still got more work to do, and we still give them a high momentum score. They have also seen a very nice fall in their spread, leading to a capital gain for those corporate bonds. So for us, it's as much about the journey as the destination. We want to be along for the ride with these companies that are improving for the better.
Right. I'll get into engagement now, and I guess what I'm confused about, and again, we cover a bit on equities. The biggest issue I think with engagement is that fixed income investors or bondholders, you don't have a seat at the company AGM. You're not owners. And as such, can you really influence behavior?
Yes, so that's a question we had ourselves many years ago. And what we found is we do have a lot of power, especially for repeat issuers. If they have to keep coming back to the bond market, they actually do listen to what you have to say. So we record all of our engagements in our database, we report on them. Most engagements, I'd say, are successful, but some are failures. And when they are failures, that leads to portfolio action, which normally means selling bonds. So, Charlene will have some high yield examples. In my investment grade world, I would say our highest profile success was Aviva, life insurance company. A few years ago, they wanted to do something that we fundamentally disagreed with, and we engaged with them at the highest level we possibly can, which meant our chief executive directly spoke to their new CFO. We expressed our displeasure. They said, well, what we're doing is not illegal, so we're going to carry on anyway. And at that point, we felt, well, what else can we do? Well, we have a blog that we send out 2 to 3 times a week. We blogged about the company, we criticized their behavior, and within 1 week of that, they reversed their position. So that was a success, which meant we could keep holding the bonds. An example I can give you of failure was last year, we have a student finance investment, which was actually sponsored by private equity. And when the bond came to market, they promised us some CO2 data. Months went by, we couldn't get this data. We kept getting the manana story. Eventually, we had to take a call and say, look, we're not getting this data. We have to exit this position. So the key point for us is, some are failures, some are successes, but we record all of them and we report on them monthly to our clients. And the feedback seems to be very good. Clients love to read these war stories. And I'm sure Charlene has a few on the high yield side.
Yeah, definitely. Yeah, same as Chris. Some are successes where we can address our concerns to them and we hear them and they action them, and that could be straight away or it could be over 6 months or whatever it might be, and we know to check in. I guess people like to hear more about the failures where it hasn't worked and what we've done. So another UK insurance company, they did something from the governance front that we thought was really poor. Again, our CEO had a call with their management. We were quite happy that they responded to us straight away. We had a call literally the next day with them, but we weren't being heard, and we felt that they weren't really taking our concerns into account. So we decided to reduce our position there. Other times we've decided to exit completely. There was a US name where we were trying to get ESG data for them, just basic data, emissions, kind of diversity data, and they refused to even have a conversation with us. And for us, that was enough ground to sell as well. Other times we can choose not to participate in a refinancing, and given that we're high conviction bond managers, that can be quite meaningful to some companies. And we always make it clear why, if we're not participating, why that is and what specific reason. And that will go to the bank that's running that deal, but also back to the company, so they know exactly why. And then other times as well, we either reduce position or can exit it entirely and put a block on buying that until we see change from the.
I like your comment about the block. It's the power of the pen. Now, in my opening remarks for this section, I obviously talked about the fact that fixed income is not about ownership, and bonds. I guess when you think bonds and fixed income is about cost of capital. Chris, you made a comment that these companies would have to go back to the capital markets to secure subsequent financing. When they don't engage, is this non-engagement or lack of disclosure or any of that, is that reflected in the cost of capital for subsequent funding? I mean, do you see the correlation there?
For many years, it wasn't at all, but it really is now starting to drive behavior and the pricing of debt. I mean, we've seen a trend in Europe, certainly, where green bonds have been trading at quite a significant premium. Paradoxically, that makes them a problem for us because the lack of yield in that sector means it's bonds typically we don't invest in. I mean, not wholesale, there are some individual cases, but generally speaking, we don't like green bonds. They have some of the lowest yields in all of fixed income and also some of the highest volatility. So for us, the risk-adjusted returns are just not attractive enough. But companies have clearly got the message, and they know that they can tap the markets more cheaply if they bring a deal to market and classify it as a green bond. So companies, I'd say in Europe, have definitely got the message. I've noticed a big sea change in US companies just in the last 12 months, really. So I think the whole world is now appreciating that the cost of capital is affected by your ESG profile.
Yeah, it's a nice segue into green bonds, and that's a big stop. But if I could bring it together, so there's the concept around ESG integration, and there's sustainability-focused bonds. There are green bonds, and I hear there are SDG bonds, so Sustainable Development Goal bonds. Maybe let's start. What's the difference? Are these on a spectrum, or are these mutually exclusive? How does it work?
Indeed, and the terminology is very confusing and different. Well, the same word can mean many different things to different investors. So I'll give you our interpretation of the word. ESG integration for us means you can invest in anything you like, in any sector you like. The key point is you have thought about these ESG risks before you make the investment. So integration still allows you to buy oil, it still allows you to buy alcohol or tobacco bonds. The key point is you've said, well, there are additional risks here. Am I being compensated for those risks? And we use ESG integration in all of our portfolios because certainly for investment grade, I think at the very least, ESG integration can help you avoid the losers. It can help you identify those companies that the future is going to be a problem for. When we talk about sustainability, there are different flavors of this. We have sustainable funds, which have additional screening work applied to them, which means they are not allowed to invest in sectors such as oil, such as alcohol, such as tobacco. And more than that, they need to have a minimum score for every investment that's actually quite a high threshold. But there are also sustainably linked bonds, which have special features, such as the company needs to have improved its emissions in this particular area, or the coupon on that bond will increase. So the interesting thing for me for sustainability linked bonds versus green bonds is green bonds tend not to have any financial penalty. So the company can issue a green bond, the capital can leak into other parts of the business. There are no penalties for them not living up to promises. When it comes to sustainability linked bonds, there can be penalties. But it's a confusing space, and in Europe we have some also confusing legislation called SFDR, Sustainable Finance Disclosure Review, which characterizes open-ended funds into being either Article 6, which really means no ESG, Article 8 or Article 9. Article 8 is such a wide open space. You have a very wide range of funds within that space that can be very light green or very dark green, and it's very confusing for investors to know how dark green each potential fund is. So when we use the word sustainable, what we really mean is screening. And I'm sure we'll come on to talk about this, but we found when you screen a credit portfolio, there are some volatility consequences that perhaps many investors were not aware of.
Charlene, I guess in your coverage of high yields, how do you see the landscape there?
Yeah, so I guess the issuance of green bonds, there will be the odd one, but it's not quite as much as we get in the investment grade market. We have started to see bonds that Chris touched on, that are sustainability linked bonds, where management will have, they will set a couple of targets, a couple of sustainable targets within that bond. They will be clearly defined. they'll be measurable, there'll be a deadline as well as to when they have to achieve those. And if they don't achieve those, there's a direct penalty for them, as Chris was saying. So the cases that we've seen, there's a coupon step up. So management then have to pay the holders of that bond, the company has to pay the holders of that bond more interest because they haven't delivered on what they said they were going to. And we expect to see more and more bond issues like that. One, it's good for investors like us because it holds the company directly accountable. And two, it allows management to allows a company to kind of focus on a couple of key ESG metrics, but use the money how they see fit, as long as they're kind of delivering on what they say they're going to deliver on.
Let's get on a couple of examples, because there's been a few cases, that had publicity in the media. If I could go into Philip Morris. So I noticed that they recently issued what they call sustainably focused bonds. And again, as a background to our audience, what I read is that the framework includes 2 sustainability performance targets based on reaching them in the year 2025, so not far from now. So these 2 targets are, firstly, to reach more than 50% of their revenues from smoke-free products compared to 23 currently. So an increase in revenue from smoke-free, that's first. And the second target is to make smoke-free products available for sale in 100 markets compared to 64 currently. So it's like the step in the correct direction, towards smoke-free, and it's a sustainably focused bonds. Question to both of you: is that greenwashing?
Well, it could be. I mean, I'm a Scotsman. I tend to be skeptical of most things, but the tobacco sector for me really has angered us for a few years, because not specifically Philip Morris, but British American Tobacco a few years ago, we had a company meeting with them. They were talking about their push into vaping. This is going to be a driver of revenue growth. And we asked them a question, well, is there nicotine in the vaping product? And they said, yes, there is, but don't worry, nicotine's not addictive. And we thought, well, this is crazy. No one thinks this. So we quickly realized that there's a cultural problem with the company, and we haven't invested in tobacco for many years. When it comes to Philip Morris, I'm a little bit skeptical on this one, because part of the proceeds from this bond are going to be used to buy an inhaling business. So it seems a bit strange to me that you would sell a product that might, worsen asthma for many people, and then you're going to have another business that's going to help asthma. So it's one I'm going to stay away from. Other people might decide that they are moving the right way and that's good enough for them, but for me, there's still too many questions in this sector.
Charlene, how about yourself?
Yeah, I think I tend to agree with Chris on this one. It's sometimes you find that whether it's a sustainability linked bond or a green bond, and they've been very clear about what they're trying to do, but as Chris said, if the use of proceeds is going to something that's actually not very ESG friendly, it's quite a hard thing to ignore in my view.
So if I could follow up this question, so I guess the general consensus, if you like, is, well, it looks a little fishy, we're not sure, it looks a bit like greenwashing. Now, if I take this analogy into the energy and utilities sector, in the case of Philip Morris, they are trying to, if you like, improve social outcomes, right? In the energy utility sector, it's around climate change. So I guess the simple question is that, is it all right? Is it okay for brown companies, energy, polluting companies and the like, to issue green bonds because you're trying to do something for climate change? Same thing or different?
It's in many ways it's the same. I would cut the energy sector a little bit more slack, because this is a problem that the whole world has. We need to move these companies the right way. And this is where I'd say on an individual basis, you can make a case. So Shell, a company I wouldn't invest in, BP has been investing a huge amount in renewable technology, and we want to help them with that journey. So we feel you can either exclude them, which is not going to encourage them to do anything, or you can say, well, if you do these things, then we can invest in you, we can help lower your cost of capital. And that tends to be a useful conversation, and everyone can win from that. So I'd say it really is on a case-by-case basis. We all use energy, and we need to see a cleaner world. So if we can help the transition process a little bit more quickly, then that's a good thing.
Charlene, any to add, or if I could move on to the next question?
No, I think again, Chris
Yeah.
covered the main points there. So
yeah. Great. To our audience, I will encourage, we've got about 5 or so minutes left, so please feel free to add more questions if you like. If not, I'll keep rambling on. Chris, back to earlier definition when I asked you about the difference between ESG integration and sustainability focus and green bonds and labels and the like. I think was it last week or the week before, the US SEC and I think the German regulator as well started probing this large global fund management company on allegations of greenwashing made by one of their former employees, head of ESG at that firm. And I noticed, and this is reported in the media, so in its defense, this fund management company explained that it had differentiated between what they call ESG integrated sort of assets under management versus ESG dedicated funds under management when presenting those figures in their annual report. Does this come out of the confusion, as you've tried to clarify earlier around, ESG integration? I guess the way I see it, there's a price for everything, right? You can invest into so-called sin industries, assuming your risk-return metrics works for you. Whereas on the other hand, there is that exclusion type strategy in place.
Absolutely, and it comes down to understanding the provider really, because when we say ESG integration, we mean we score everything we invest in. Whether it's investment grade or high yield, we have to give them an ESG score. But it turns out, what it appears, that other providers may say, well, we'll score a third of our investments or a half of them, but use the phrase ESG integration for everything we do. So I think investors need to understand, when they see ESG integration, do they mean everything in their book, or only the sustainable fund range, for example? So I agree, it's very confusing for investors. And you can't just tick a box on this and say, well, they say they do ESG integration, that's good enough. You do need to do more work to find out, well, what proportion of your universe do you have an ESG score for? And Tesla's the great test case. We always ask people, how do you score Tesla? Is it good? Is it bad? Is it somewhere in the middle? Because that tells you a lot about the model they're using.
I have a question coming up from the audience, and in fact, it's a nice way to relate to my last point here around government bonds, because at the end of the day, we talk about ESG. It's around the whole of portfolio. It's about diversification, downside risk, and so on. So the question I might just read out to you, as your focus is on downside risk, have you observed which of the E, S, or G factors are being priced, spreads widen? So which are being priced the most when an event occurs? Or is there a difference across different maturities?
It's a very good question. And in fact, it was work I saw on this many years ago that first alerted me to the potential of ESG for credit. And the piece I'm referring to is the Barclays Equity Gilt study from many years ago. And they did a whole analysis and showed that governance has been the most strongly correlated factor for credit performance for many, many years and continues to be so. But about 5 years ago, environmental factors started being positively correlated to credit performance, and that correlation has increased. 5 years ago, the social factor was uncorrelated, but there's now evidence that it is weakly but positively correlated to credit performance. But it does depend on the sector. I mean, the social category is now starting to divide the banking sector, for example. So you can get challenger banks, you can have established banks, you can have investment banks. The social score there can be very important for determining your view on that company. So not just from that side, but also the weight of money argument. There's so much capital flowing into sustainable strategies that we believe ESG will continue to drive credit performance for many years. Ultimately, we will have some legacy trapped assets, maybe alcohol, maybe tobacco, for example, that will trade at very cheap yields. And that will present a dilemma, I suspect, for many people, because at that point, you've got some potentially juicy yields. Maybe those companies ultimately become private companies and may be funded from some other part of the world, let's say. But the interesting thing in fixed income is the cost of capital does ultimately drive the return of those bonds. And sustainable credit can push cost of capital down for the right companies. The less right companies are going to be paying higher yields, and that might be attractive to some people.
I'll cover government bonds. I think, Charlene, if I come to you, there is a difference between, developed country, G7 bonds, and emerging markets. I guess the broader question is, are government bonds sustainable, or are they deemed so? And how do you then break it down? Perhaps you could explain.
Yeah, it's a good question. I think from our perspective, to effectively manage a portfolio through the cycle, we need access to risk-off assets. And our view of that is kind of G7 developed market government bonds, so kind of the US treasuries, gilts, bonds. If we were to look at kind of emerging market governments, we view that kind of very differently to risk-off assets. We view those more as risk-on. We consider that as part of our allocation in our portfolios rather than as our risk-off government allocation. And then as a result, that means that we then have to do the ESG analysis for those governments. So if we were to ever look at whether it was China or a Turkish bond, for instance, we would then do the ESG analysis at a country level. And I appreciate the questions there will be different than what we would ask for a company, but we would still go through the process and do a score because we consider it as part of our risk-on allocation. But for our risk-off allocation, we consider the G7 governments as part of our risk-off bucket that we need to have access to for the portfolios.
And Chris, do you think all government bonds fail that test, the threshold for corporates from a sustainability perspective?
Absolutely. I mean, they manufacture and use weapons. So that your first point is that, really no government bonds deserve to be in a sustainable fund. In our investment grade world, we allow treasuries, bonds and gilts only because we need a risk-off hedge instrument. And essentially they get a carve out for that reason. But any other country would have to be scored as if it was a credit.
And I guess in closing, when you bring it all together, there's a role for government bonds. I mean, the defensive characteristics. And I think in the same light, when you look at the energy and utilities company, these are companies with defensive characteristics. I know we've been covering ESG related issues today, but when you bring it all together, is there the conflict? How do you bring it together when sometimes it's not near perfect in that sense? You want ESG characteristics, you want defensive, it's about the portfolio construction. How does that all come together?
It's a great question, Tech, and this is the problem we agonized over for some time, because if you could turn to slide 4, please. Quant work I did a few years ago asked the question, if we take one of our strategies and we make it sustainable, by which I mean we remove some sectors, what happens? So the green dot is where we started in terms of risk-adjusted returns. When we removed sectors such as alcohol, tobacco and oil, we moved down to this blue dot that you can see called negative screen. #92 is the number of bonds we were left with. And what we found was, when you screen a credit portfolio, you're often removing the most defensive sectors, the non-financial sectors that tend to have high margins with very stable cash flows. So when you have a beta-led sell-off in financials, such as in Q1 16, for example, those sectors tend to protect your capital better. So when you can't own them in your sustainable fund, you end up with A, more volatility, and B, actually a lower annualized return. So we felt the destruction of the Sharpe ratio here was so bad that there was no way we could launch a sustainable fund. But then the other blue dots shown here are when we divided that portfolio into its decile of ESG score. And what I found that really surprised me was there was clearly a linear link here between the higher the ESG score of the company, then the performance of those bonds tended to be better. However, every time you set the ESG bar higher, you're narrowing the breadth of your portfolio, which also brings with it volatility. So for us, the sweet spot was essentially this orange dot, where we got the best balance of risk versus reward versus the ESG score. And the magic number that we came up with was 34 out of 100. That might sound like a very low number in our ESG model, but remember the median score is 36. So actually by saying for our sustainable funds, every company needs to have a score of at least 34, means you're excluding almost half of your credit universe just on that basis alone. But what we found was the orange dot has very similar returns to the ESG integration version, which is the green dot, albeit with slightly higher vol. So a question I get asked a lot is, if you believe in sustainability, why aren't all of your funds sustainable? And it's for this reason that what we say is essentially the ESG integration fund is likely to have a higher Sharpe ratio because the vol will be slightly lower. Whereas if you care about sustainability, you can have very similar total returns, but they are likely to come with modestly higher volatility.
Yeah, I think look, that in itself presents a dilemma, and certainly, at the end of the day, as investors, you need to bring these different conflicting objectives in, because it's about portfolio construction. It's about meeting the needs of their constituency, whether they are retiree members or the government, or the constituency that you're trying to serve. That's all the time we have. I know in the last 40 or so minutes, we've attempted to sort of flesh out lots of problems. We probably need another webinar to talk about the solutions. But hopefully, again, that honesty, thank you very much to Chris and Charlene. Hopefully that's been useful and that resonates with our investor audience. On that note, thank you very much, Chris, Charlene, and to the investor audience. I hope this has been meaningful. Stay safe, and hopefully see you next time in person. Bye for now.
Thank you. Bye.
Thank you.